Folks, how are we doing today? Okay, so today we're talking about a new high income ETF. It's one that folks have been talking about in the comments. People like it, and I want to unpack it. Okay, it's called KQQQ, and it's from Curve, guys. Let's just jump right into it. All right, guys. First and foremost, as per usual, guys, thank you to the 113 members we have on the Patreon today, guys. I cannot thank you enough for your support, guys. If you want to participate in the Patreon, please go to the link below and sign up. It's $5 a month, and you get access to all the calculators, or $15 a month, and we can do one-on-one coaching sessions, and ultimately we can do a little engagement that I think you will benefit from. Right, so just jump to the Patreon, and I cannot thank you enough for the support. All right, guys. So we are here at curveinvest.com and we are looking at the Curve Technology Titan Select ETF. The ticker symbol is KQQQ. I have been hearing a lot of comments on about this ETF in the comments in various videos that I've done. And so I wanted to do an analysis of this product and, of course, not financial advice, but give you my pros and cons to it and tell you if I like it or not. Again, not financial advice. All right. So looking at the basics. So of course, ticker symbol is KQQQ. Their gross expense ratio or net expense ratio, just about 1%, which is a little bit higher and on the higher side from what we've seen. Their distributions are monthly. Their inception date is July of 2022 and 2024. So they've been out for a little over a year and a bit. All right. So what are the potential benefits of KQQQ? Well, what they've said is they're removing non-technology companies to help gain pure exposure to top technology growth stocks through smart security selection. All right, so they've handpicked a selection of tech stocks to add into this ETF basket. We will look at what those are. All right, and so they have a dynamic optimization model where they can balance between synthetic positions created on some of the assets and then just own the underlying asset for some other positions. They will do that dynamically. They're looking to seek maximum growth through the names on a weighted basis based on momentum signals. Here, what they're saying is they're going to write covered calls to seek income on stocks with limited upside potential or low price momentum, which can also serve as mitigating the downside. And I don't know if that's actually true to what they're actually doing when looking at their holdings and looking at their strategy. They are writing covered calls on their assets, but I don't know that's necessarily on some of the positions that are have low upside. And we can look at what that looks like in a moment. All right, so we're going to look at their prospectus, and it will show us a lot of what they're doing. And they have a lot of different strategies going on with this ETF. To start off with, guys, they are investing, as I mentioned, in securities and derivative instruments, so options. But they are also investing a portion of the assets in the Curve Yield Premium ETF that they have and other related ETFs that they have. And I'll show you those ones that they have invested in. I think that is a downside. I don't know why they need to necessarily invest in their other products within this. They have a reason behind doing so, of course, to generate the yield through this ETF. But also, is that kind of double dipping your expense ratios? Like you're gonna essentially you're getting an expense ratio from this from the assets under management when they're investing in this ETF, but then they're investing those assets in some of their other ETFs. So they're kind of double dipping and getting more MER out of it. So that's something I'm not super in love with. Next, what they're doing, so they have a portion that's going to be synthetic long exposure. So they will create synthetic positions and go effectively long with them. So they're betting on their upside. And you can see here that any synthetic position, they will not exceed 150% of the net asset value. So they are creating, like I said, synthetic positions. Those will amplify leverage and amplify the upside, but at the same time expand the downside. So what else will they be doing? Well, they'll also be running covered calls on a selection of the securities under management or indices as well. And so it's not necessarily on the full suite of equities that they manage, but they'll definitely be writing covered calls on a portion of the equities. They'll also be writing uncovered calls or put writing. And the principal reason here they're saying is to generate income without committing the capital of the ownership of the underlying securities. All right. And that is definitely a high risk option that they're doing, a high risk strategy. They also have call put spreads. They also have downside protection with protective callers. They also have protective puts. They also have call purchases, and they also do short dated fixed income and foreign exchange instruments for holding small cash positions. So there is a lot going on here, guys. There is a lot of different strategies that they have going on, and we can look at and validate some of those strategies with their holdings. Okay. So looking at their holdings, as I mentioned before, they are invested in some of their ETFs. So they have a portion of the assets in their other ETFs. I don't love that idea, but they're doing so. They have a number of synthetic positions with Apple, with Microsoft, with NVIDIA, AVGO, CRM, Google. All right. They have some downside protection here. And then they have some downside protection here with the Roundhill Magnificent 7 ETF here. So that's another thing they're doing for downside protection. They own the underlying assets, like they own Apple, Broadcom, Salesforce, Cisco, Alphabet, IBM, Meta, Microsoft, Netflix, NVIDIA, etc. But they're certainly writing calls on those covered calls, as well as creating new synthetic positions on those as well. All right. So they got a lot of things going on here. That's to their benefit, and their total performance is a testament to them actually yielding some good results. But at the same time, you have to know what you're getting yourself involved here. All right. This is not just a tried and true, just standard covered call ETF, writing covered calls on their net assets. They are amplifying their leverage with synthetic position. They are investing in other ETFs of their own. They have downside protection with the Roundhill puts. For some reason, they went here, and again, maybe leave a comment down below. But they have puts here from using the Magnificent 7 Roundhill product. They have, of course, cash positions with these treasuries. And then, of course, they have just standard underlying assets here. So a lot of things going on here. Some good, some bad, some interesting. And let's just look at their total performance, okay? All right, so you're in Seeking Alpha, guys, and we're going to compare KQQQ to QDVO, which is Amplify's product, QQQI, which is Neos's, and then IQQQ, which is ProShares, okay? And from a price return standpoint, KQQQ over the past year has actually been the strongest price returner with 14% versus QDVO's 12%, QQQI's 4.3%, and IQQQ at 5.2%. But let's flip it to total return to see what it looks like here, okay? So KQQQ over a 1 year period actually is the strongest, guys, in terms of total return, with 26% total return over the past year versus QDVO's 24 and QQQI's 20%, and IQQQ's 18 to 19%. So, they have something going on here. Again, they have a lot of different strategies and things that they're doing dynamically. So you have to kind of trust their management. This is an actively managed ETF, but so far so good, right? They're beating a lot of these other top dogs in this race. So I think this is an ETF that goes underlooked. I think if you want an isolation to those names that they're invested in, this deserves a look. Not financial advice, but I don't love synthetics as much. And I know that even Neos is going to get involved in this soon. But for me, like, I rather like a QQQI. I don't believe QDVO has synthetics, but a QDVO. Double check that. But you can't deny KQQQ's 1 year returns, and it's better than the rest. So, guys, let me know in the comments if you're investing in KQQQ. I can't say that 5 times. KQQQ. Guys, sub to the channel. All the best and cheers.